Dear friends, welcome to the monthly outlook on markets. Markets continued its strong run during the month. However, with the increased volatility, the narrative during the month was driven by changing election expectations. Consequently, FIIs have been net sellers in the month of May. This is third time in this calendar year that they have been net sellers. However, as usual, retail participation continues to be strong via the SIP. Corporates have just reported their quarterly performances. Earnings for the quarter have been largely in line with estimates. Domestic cyclicals like auto, real estate, capex driven businesses, BFSI continued their superior earnings growth trajectory, whereas sectors like energy, metals, and IT face challenges. The confidence on Indian markets also stem from this healthy corporate performances that we are witnessing. Let us now look at the performances of different sectors. Interestingly, majority of the auto companies reported strong operational performance on the back of healthy vehicle sales. They are also benefiting from the benign raw material cost, favorable product mix. Interestingly, premium vehicles are selling more than the entry level ones. So how does demand outlook look like? Demand outlook for FY25 seems positive. This is on the back of likely normal monsoon, which would revive rural economy and rural demand. We are more confident on two-wheeler demand as compared to passenger vehicles or commercial vehicles. Two-wheeler OEMs are also more confident on healthy growth momentum for the industry, considering that the volumes in two-wheelers are still below the previous peak, while two-wheeler upcycle has just begun. Passenger vehicles and commercial vehicles, both these corporates are talking of flattish to mid-single digit growth in volumes for FY25. In our portfolios, we have decent exposure to auto space and will continue to look for additional opportunities. Banks' earnings were actually better than anticipated, with in-line or better net interest income for most banks. Our observation was that banks have not undertaken significant hikes in deposit rates over the past 4-5 months. Therefore, we anticipated only minimal rise in incremental deposit costs, while yields may slightly move up as new loans that have been booked in last 1.5 years start contributing to outstanding book. Most banks have guided for steady NIMs, with both yields and funding cost expected to move up nominally in the first half of this fiscal year and then start easing in the second half. Retail deposit growth continues to remain a challenge, especially at appropriate pricing. We in general have lower weights in banks as compared to NBFCs in our portfolios. Let us now move on to NBFCs. Bottoming out on margins, while some even reported a slight uptick, was the hallmark of this quarter. Asset quality too improved during the quarter. We expect lower credit cost in FY25 as we enter a normalized macro environment. Growth continued to be healthy for most NBFCs. With margins bottoming out, moderation in credit cost, and operating leverage unlocking in FY25 and FY26, we expect NBFCs to continue to report their strong earnings growth trajectory. As discussed, we continue to have higher weight in NBFCs as compared to banks in our portfolios. Okay, let's now move on to chemicals and agrochemicals. The industry is witnessing one of its most challenging times due to continued Chinese destocking and pricing pressure. While the volume growth challenges have likely bottomed out, pricing is expected to continue to be a challenge. Most managements are now talking of recovery from H2 onwards. However, given the uncertainty of Chinese production, pricing strategies, the trajectory of this H2 recovery still needs to be seen. Over last few quarters, we have reduced exposure to this area. Consumer products saw uptick in demand. Room AC companies registered a healthy volume growth on strong onset of summer, which drove increased primary sales to channel partners. Volume growth for Q1 FY25 should sustain owing to strong summer sales continuing. Cable and wire companies also sustained its strong volume growth with healthy margins led by continued B2B demand, uptick in construction and real estate activities. Companies in both these spaces are seeing early signs of demand revival. Recent spike in copper prices need to be monitored for their impact on margins. This should boost revenues for cable and wire companies due to better realization, while margins are expected to remain stable. We have a decent exposure in many cable and wire companies. While the quarter gone by has shown performance largely mirroring the trends that we have seen in last few quarters. However, management commentaries of all the FMCG companies that have reported results have alluded to the recovery in rural demand. A considerable decline in prices of major commodities led to sharp jump in gross margins. However, companies have actually been reinvesting most of these gains in product innovation, distribution expansion, marketing spending, and this has limited operating margin expansion. However, this is good for their long-term business growth trajectory. Companies have also been reworking their distribution strategy to increase direct reach and expand their rural coverage. Premium portfolio, which generally is 10 to 30% of revenues for most of these businesses, continue to perform really well for most companies. So how do we see outlook going forward for FMCG companies? We believe the anticipated recovery in rural demand. With this, FMCG companies' volume growth should be back to its historical average of mid to high single digit volume growth. This will be coupled with 4 to 6% pricing growth due to moderate commodity inflation is likely to fuel FMCG companies' growth back to their long-term growth trajectory. Also, another area of consumers, largely tourism, is on a strong footing. Aviation and hospitality businesses have reported very strong set of numbers. Businesses and margins are all-time highs, and the focus on infra creation and changes in consumption pattern bodes very well for the businesses in this space in the medium term. Software services companies actually fell short of already subdued expectations, and also margins were further impacted despite stagnant hiring and a slight uptick in utilization. For FY24, the top 5 IT services companies combined added just $1.4 billion. This is just 1.8% of revenues. This is despite the fact that software services companies have seen 29% growth in TCVs. While one reason for the slow top line growth is the increased duration, the bigger factor is the higher cancellation rate in renewals. For FY25, once again, margin management would be a priority. Clients are cautious with their spending, which is putting pressure on discretionary budgets. Cost takeout projects continue to be favorable for the sector, with clients demanding immediate ROI. We continue to remain underweight in this space. Key highlights for the pharma sector actually continues to be stabilization and improvement in the US business. This is largely due to the continued easing pricing pressure and drug shortage being at multi-year highs post recent US FDA actions across plants. Given the fixed cost business model, a recovery in US business has also augured well for companies from a margin perspective. The domestic oriented businesses continues to perform well on expected lines though. We continue to remain invested in this space. So how does the entire India Incorporate performance look like? Overall, performance for FY24 has been really strong. In FY25, markets may need to contend with several challenges, including heightened geopolitical tensions, slowing rate of earnings growth, and seemingly premium valuations. Despite these challenges, we believe Indian economy is positioned well for the coming year. Acceleration in government capex in the past 2 years can boost private capex in the upcoming one. Also, onset of La Nina conditions can boost rural farm income, leading to recovery in rural economy, which has remained elusive till now. Overall, we continue to believe Indian markets are favorably poised for long-term superior compounding returns. Thank you.